hit the button too fast. All right. Hi, everyone, and welcome, Jeannie. I am just making sure my phone is not going to make a noise. Give me 1 second. I want to make sure I can see the comments in Facebook. So, all right, I think I have that set up. I agree. All right. Hi, everyone. I'm Mary Ann, and I am a licensed insolvency trustee with Allen Marshall and Associates. And I'm also known as Dr. Debt because I help people have happier, healthier finances. So welcome to this Lunch and Learn series. And this is where we get to hang out with some incredible people who have some wonderful advice for you on something to do with your finances. And so my guest today is Jeannie McCulloch, also known as the Mortgage Jeannie. And we're going to talk about how to afford a home in today's market. And we're going to get a little creative. So this is going to be a fun discussion with a very fun person. Welcome, Jeannie.
Hello, Marianne. How are you?
Wonderful. Thank you.
Awesome to
Uh,
be here.
Great. I'm so glad you made it and we got technology working. It seems like I have a little bit of a glitch, so hopefully there's not too much of a delay there. So just a little bit of housekeeping. Anybody who is watching that has questions, just feel free to post those. I do believe I have it set up so that I can get comments. So whenever, well, I guess two things. If you're here now, just say hello, and that way I can test it to see if I'm getting comments. Oh, you know what I'm going to do? I'm going to test it myself. I'm going to say hi to myself. Hi, Marianne. I'm not actually putting that. I'm just saying hi. So I just put a little post in the comment and there it popped up. Yay, that's working. Okay. Anyone listening to the replay, you can ask a question and Jeannie and I will respond to it afterwards. So just put hashtag replay and we'll know that you're listening to the replay. Let's jump in. So I want to know a little bit about the Mortgage Jeannie. So tell me, Jeannie, how long have you been in the mortgage broker business?
Well, that is a great question. I guess I'd start off saying in just straight mortgage brokerage, 2 years almost, but I come from a 25-year background in finance where I was a CFO and quite used to dealing with banks and lenders and things like that. So I brought that skill set. I thought I just love helping people, and I said that's it. I want to find a job where I can use those skills to help an individual, regular person. And that's what I've done, and I'm really enjoying it. And I guess a lot of the skills are transferable, which has really given me a jump start in the industry because some people said, oh my gosh, it's horrible, jumping from a corporate job to this, but it's been absolutely great. Never missed a beat, and it's quite nice to be able to help people.
Awesome. And I think that speaks to the fact that this is just such a natural fit for you. And I think you answered my next question, which is what made you get into this line of business. And you answered that. It's because you genuinely want to help people. And, let's face it, right now in the world economy, getting finances for a home, getting into a home, buying a home, people need a little extra guidance today, a little bit more than they did before. And I think that you are perfectly suited to that. I know that I've had the opportunity to send people your way who are looking to be homeowners, and you always give them such valuable advice, and you always deal with them in such a wonderful, personal way. So I just wanted to put that out there and give you a little thank you right off the bat.
I appreciate you and your referrals. And honestly, I feel like you're a great person to work with because ultimately we may not have the buckets of money to make something happen this moment, but we do have enough to make a plan for people, which if you have a plan and you can execute in 3 months, 3 days, 3 years, it just makes you feel like you're on a road to getting a house. And a lot of people don't realize just having that plan is key. And you're so great at looking at debt and things like that. So it's a big project getting home.
Yeah, it is. Thank you for that. And to our viewers, thank you for enduring our love moment. We
Love.
we come together quite often to help individuals, and so we both really appreciate that relationship for sure. Okay, let's dig into our topic at hand. So, how to afford a home in today's crazy market. I should have put that in there. And
Yeah.
let's get creative, because a lot of times when you and I are talking, we're getting very creative in terms of how we can help individuals. So a couple things came up as you and I were talking about this, and one of the big ones, and this is something that I'm very passionate about. I get a lot of inquiries about this. I'm always posting on social media about this. Credit scores. And so a lot, qualifying for mortgage is very dependent on credit scores and debt ratios. And let's just talk a little bit about that. So, what are you seeing nowadays? People are coming to you. Do you generally see high scores, low scores? Is it all over the board?
Well, right now we're still seeing a lot of people coming out of the COVID suffering, where they couldn't make payments. Maybe their jobs were on hold or laid off. So we do see kind of a mixture of people and still coming out of the COVID phase and those with high. But the credit is so important. And as you know, Marianne, there's the 4 C's of credit. So there's character, capacity, capital, and collateral. And that score and all that together is what really makes the big picture for us to get a lender. But I would say right now scores can go from 490 to 850 or more. So it's kind of a collective mess depending on how much suffering went on during COVID.
I want to put those 4 C's in. I actually haven't heard those for a while. I haven't referred to those for a while. Character, capacity,
Yeah.
and
Capital
capital,
and collateral.
and collateral. So, because I was going to say, let's talk a little bit about credit bureaus and credit scores just for a moment, because not everyone knows what that is. So, I'm just going to pop these four up here and we're going to talk about that. So, just before I ask you some questions around that, um, generally, I'll just offer a few little tidbits of information. I've done a lot of research into credit reports and credit scores. I do a lot of trainings on them. And, generally speaking, scores range from 3 to 900. 650 is the middle of the road. So if you're below that, there's going to be some challenges. If you're above that, the more above that you are, the less challenges you have. The higher your score, the lower the interest rate that you pay. That's how I always explain it to people.
Yeah.
So, but we get really focused on our credit score. And so I often talk about something called credit worthiness, because your credit score is only one piece. And that's where I think these 4 C's are coming in. So credit worthiness is your credit score. It's also your debt ratio, which we're going to talk about because that's going to fall under capacity, and your income or job situation, right? That's the third piece that really plays into it. So tell me how character applies to credit score, credit worthiness.
Well, for people buying their first home, which is an incredibly big step, the first thing you need to do is demonstrate your credit worthiness. So basically, it comes to the credit rating, and that's built on the 4 C's, as you said, Marianne. Basically, your character and your history on how do you pay your debts. Do you pay them on time? Are you always late? Do you, maybe leave them for 6 months in dispute and then pay? All of these ways that you deal with credit is all that a person can look at and see on your report, and it impacts your credit score. So even though you may want to dispute or what have you, I get that, because of course we all don't want to pay for things. It's almost better to keep your payments straight and then lodge a separate dispute so you can keep your character as a person, paying the bills, and just that, you're trying to keep around 680 is really the lowest we want to see a score. So basically, yeah, the character and keeping, well, Marianne, I don't want to go too far and take away any questions, but when I look at character, I'm kind of wondering, okay, if you pay on time, utilization rate of credit, we like to see that, like, always keep it down around 30% of your limits, because that helps to up your credit score. Of course, Marianne's a wizard on that. And if you need it to go up faster, you just need to start keeping the balances lower and just keep on making your payments on time. It really helps. So that's
Yeah.
really us analyzing your character when it comes to debt. Are you don't care, or you really care that you meet your end of the deal with the creditors.
Yeah, and the credit score is becoming such a big part of that just because, there's I'm going to say there's less personal decision made and more based on the numbers. However, this is why having someone like you in my wheelhouse is so important to me, because you can take that information, you're the between the lender and the person. And sometimes, and this is one of my pet peeves with credit reports and credit bureaus and credit scores, sometimes there's a reason that it's a bit messed up, and getting it fixed can be really challenging. And so having someone that can kind of go to bat and explain that is so important. So that's character. So capacity, I think is fairly self-explanatory, but basically, can you afford the payments, right?
Yeah, and especially loan payments. So you may have your credit card payments not happening timely, which is, but when you start messing with loan payments, now that's your capacity. It's being used up by loan payments. Your credit is going up and down, but when you mess with those loans, you are messing with the big guns. That's
Mhm.
really, really hard on your credit score.
Yeah, and I think that's because they kind of weigh it that way. I mean, with it, they're two different beasts, right? So you have your using credit bureau jargon. You have your revolving credit, which is credit cards, lines of credit. They always change. You use them, you pay them. That's one side, and then the other is installment debt, which is loans, set amount you pay it every month. And yeah, you're right. Like if those payments aren't made, it kind of reflects your ability to be organized and structured and committed, right? It says even a little bit more than if you're missing some of those other payments.
Yeah, it does matter. And the lenders really, they only have that. Like, I might know you as a person, say, oh my gosh, I know there's a reason for all this. And I can sell that information to a lender, as could you. But if nobody tells them your story, if you had a legit reason, then that is all they know of your character. And
Mm,
now they're going to say, well, my gosh, they can't make those loan payments. Now they're over their capacity. They're just over the limit for them personally to handle. So yeah, you
yeah.
want to be mindful of all that stuff.
Yeah, and debt ratio, which is the other factor, comes into play just in terms of how much debt do you have? What are you looking for in terms of a mortgage? There's ratios as to how much you're supposed to borrow, quote unquote. So falling into that is also an important piece, correct?
Yes, of course. Yeah, for sure.
Yeah.
It's a big
Well,
deal.
what is the ratio? I know I completely go off topic. So if you have a list of where I was going with this, we're probably going to jump all over the place. Um, what's the kind of standard percentage in the industry that someone should borrow from their income for a home?
Well, everything is dependent on more to do with your credit scores, what allows you to get into the ratios. So at 680, there's ratios are usually, 34 to 39 and maybe 44 for your gross debt. But if you are, say, having bruise credit, we've got lenders who will actually let you have ratios that are quite a bit higher. And what they do to manage their risk is look at the type of property you're buying. So
Mm,
they won't let you buy something that's not going to fund them back monies if you decide not to pay those the mortgage bill. So, but yeah, those are kind of everywhere depending on what people are looking at. We could even do some um, private lenders who don't care, like
right.
they
Now, is
just don't
that debt
care.
ratio for all debt? That like 33 to 40 that you're saying, is that all debt or just mortgage debt?
30% of credit card debt is what you want to keep. 30% of the limit of your credit card.
Yep.
So if you, and really
Oh,
that's,
in utilization. So you're talking
yeah,
about in terms
you,
of using the
mhm,
amount of credit you have available.
yeah. The
Yes.
other stuff is to do with your income versus your total debt. So you'd have everything added together.
Yes.
And depending on that balance, sometimes we'll have to say you're going to pay things off to make the ratios work. Sometimes we'll go to an alt lender that lets you have
Mm,
higher ratios. And the down payment factors in. So that can also help reduce ratios because now you've got more money down and you can pay off a little bit of debt. Now you're in a different ball game again.
okay. So
So
just so I'm clear for before we leave that point. So when you look at the debt ratio, so how much debt you owe to income, you're looking at all the debt to income. So there isn't a kind of specific percentage just for your home, or does that get broken out as well?
that is more. I might not be totally getting this, but I guess when you're looking at the house now, we have the stress test. So when you're putting in your home, say you're going to have a $400,000 purchase price and 100,000 down, and now you have a mortgage of 300,000.
Yeah.
What happens next is we look at the term of the loan. So say 1 to 5 years, and the amortization might be 25 to 30, depending on what you qualify for. And so because of the new ratios, the new debt, the stress test, you basically have to qualify your debt ratios using 5.25%, which is higher, been typically higher. Now, if you're doing a fixed rate mortgage, you have to add 2%. So to that rate, that interest. So if you're doing 4% fixed rate, you have to add 2% and then qualify.
And that's to make sure that if the interest rate goes up, the person can still afford it, right?
Right. But it's really hard to qualify when you start looking at a first-time home buyer trying to be qualified at 7%. Or, you know what I mean?
Yes, I do.
It really is like shocking to people when we have to do that. They're like, what do you mean I make, 80,000 or 100,000? But now there is some interesting options there that we can look at, such as variable, and that sticks with the 5.25 stress test.
Okay.
So depending on the products, I usually look at options where they can flip to fixed or they can stay where they're at. So there's some work around there, but you do need to have a down payment. You do need to have really good credit to start looking at these things.
Now, the collateral piece, I mean, for you, I think that just goes hand in hand. So generally speaking, when we talk about credit bureaus and scores and character capacity capital collateral, collateral is having something to offer as security. But of course, when you're buying a home, that is the thing you're offering as security. So it's kind of already built into the process with you, correct?
Right. And plus, if their debt is for like a car or something that's got collateral, something like that, not just credit, we actually look at that a little different when we're sizing up how to fit that into the debt. So if they've got an asset like a car or something like that and they owe money on it, we don't just take the basic monthly payment. We can do 3% of the balance instead of having to use.
Oh, okay.
So it does help them a little bit. But once again, it just depends on each thing really needs a little look at. You can't just say, oh, every car is this way or there's always something with mortgages. Just when I think I've figured it all out, I'm like, uh-oh.
There's something else. So I guess just in keeping with that, and again, I always like to bring examples through. So for example, and I know that there will be it depends answer, but for example, if someone came to you and they have, I don't know, 50,000 in credit card debt, let's just say, and then another person comes to you and let's say incomes are equal and they have 50,000, but it's a truck loan and a car loan and an ATV loan. It might be a little easier with them than the person with just credit card debt, just in terms of fitting into these percentages, I guess. Does that make sense?
Yeah, because with credit card debt, you're going to have a monthly payment amount, and every credit card's got a different way to calculate. So that's one thing. The car loan, say you're doing 800 a month, but if I worked, car loans are pretty fixed, so that wouldn't be a good one. But say you had, I'm just trying to think. Well, I guess it depends on the type of loan, but if your loan was $800 a month loan payments, but 3% of the balance or the loan amount, you can look at that and sometimes be allowed to use it. So say it's 400.
It gives you a little more flexibility. I think that's kind of what I'm hearing is there's a little more wiggle room with that type of debt versus just straight out credit card debt or line of credit debt.
It has to be secured. So for instance, if you had a line of credit and it was run up 100 grand, that's secured with a home. So that's that kind of credit you'd get to do 3%.
Okay. All right. So we'll jump out of percentages because I don't know about anyone else, but percentages hurt my head. So, well, I'm gonna jump out of one and into the other because you talked about having a down payment. And if someone has, and one of the things that notes I'd made when you and I were talking about this offline was if someone has a lower credit score, then they potentially do need a down payment, and 20% down payment was the figure that came up. So so just talk a little bit about that when someone does need a down payment, when they don't need a down payment, and then let's talk about some ideas on where those down payments can come from.
Those are really good topics too, Marianne. So I guess what a lot of people don't realize, if your credit score typically is below 680, and sometimes that's really generous, 680. It probably should be higher by now, but anything below that, now you no longer can really get into a deal. People will go, but I'm a first time home buyer. I heard I only have to put 5% down. No, if you have Bruce credit 680 or less, now you're talking to get in with an alt lender. They also will take people that are, paying out consumer proposals. They'll add that, and they can help with that. They'll also take bankruptcy people, sometimes less than 6 months discharge. But at any rate, all of that lender market is 20% down. And that's really, really hard for people to come up with. Now, if you're 680 below that, and say we talk about how this all happened. So, I mean, I've had clients where a wife is here, maybe widowed, and all these things happen. A spouse passes away, things like this happen, and things got behind, and everything, gets blown up. And in some cases like that, or somebody blowing up their credit with a consumer proposal because of, say, marriage breakdown, maybe they were young and they just got overextended. All of those cases can usually be fit into the alt, but you need 20% down. And if you can explain really a reasonable case, they are willing to look at possibly funding or financing a part of that 20% down, but not very often. And typically, you have to have like excellent current information going on. So, but yeah, 20% is hard.
So, and with the prices of housing, of course, 20% is even more than it used to be. And, certainly for first-time home buyers, I find a lot of times people are like, well, I want to buy a house, but maybe they haven't done the planning, and then they kind of get hit with this. Okay, but there's things I need to work on, bringing my credit score up, and I need to work on a down payment. So, I think that's part of why I wanted to do this interview, is just to get that message out to someone to say, if home ownership is in your vision for the future, take some of this advice and start putting it in place now and start preparing for it. So all of a sudden you're not just going out, oh, I want to buy a home, I'm going to see if I qualify. And then you're told that your score is too low, or you need a down payment and you don't have it, for example. What are some ideas for places that people can get down payments if they haven't saved it? Because I know creatively, because we're talking about getting creative, there's some other ways to do that.
Well, I mean, basically, it's challenging when you're in the market we were just talking about. But a first-time home buyer in a basically 680 plus market, they still have to be mindful of their income versus their debt, because that's how we measure how expensive your house can be. So once you kind of get that figured out with your mortgage broker and real estate agent and get pre-approved, the next step would be down, like, where's my down payment? So in so many cases now, 5% is still a lot for people. Like, I mean, it's people, it's a lot of money to save. I've got kids that are saving it, and they keep telling me all the pain and suffering, and I keep going, keep up the good work. There you go. But I mean, you can often get a gift from a parent or a sibling, if they want to gift you, they can, and there's no limit to that. And basically, it is a faster way than saving if you can get it. If you have really good credit, sometimes, like I said, every file is special, but you can look at possibly using credit, a line of credit, to help with the down payment. They have down payment and closing costs. So basically, what that means is your 5% down plus the first time home buyers can kick in. And that's a federal program. If you put 5% down yourself, they can Also, if you're approved, they will add 5%. There's a lot more to it you have to get into, but basically, you do not have to pay that back until you sell your home. And there's some special dates and stuff. If you plan to live in the house for 5 years plus, it really is a great deal. It's not for house flippers, so this is to help people, first time home buyers, get a home. So there's that. There's also some good stuff I see on I haven't done many of these, but there's Nova Scotia Housing also has some different ways they can help with loans for down payments and also rebates. And the thing they're looking at right now is their numbers are low. It says for a house up to 300,000. Well, we know right now you're lucky if you could buy an outhouse for 300,000. It's
Yeah.
like so
I laugh, but it's painful.
it is painful. So I think they're working on moving those numbers up. I think that's in discussion somewhere in the government. But I mean, there is some interesting things I usually will take a look at for my clients because any little bit you can get from any of these funds can all help in making your monthly payment less when you take over a mortgage. So other than that, save, save, save. And I mean, if you have good credit and it's really you can get some places like credit unions. They're happy to fund the whole 5% if you have a high enough credit rating, and they'll let you add the 5% first time homeowners subsidy from the federal government. So they're very great and very wonderful to work with. But once again, you have to have a really good score to get that kind of help.
Yeah, it all comes back to that, doesn't it? The good score. I mean, that's so important. I want to come back to a couple things you said. So gifts from people, there's some rules around that, isn't there? And I remember this, I don't know where this came up. Maybe it was with a client or maybe myself in the past, but you have to prove that it's a gift. Why? Just can you explain that? Does that make sense? Am I saying the right thing?
Well, the only thing that if it's a Canadian money, then basically they fill out a gift letter and sign it and stating they're giving the person this much money. And the giver doesn't have to qualify if they took it from their savings or their checking or any of that. But where the problems come in, not really problems, but where you need to be mindful in setting it up right for your mortgage clients and their family is say if you're dealing with a country outside of Canada and the funds are coming in, because there's certain countries that are on a watch list that you can't.
Is that because of FinTrack? Is that kind of
the
purpose of that?
Like there's just certain countries where they won't accept gifts right now.
So
But,
so if sorry, because if anyone doesn't know what FinTrack is, it's just basically if there's large sums of money exchanging hands, they has to be accountable to make sure that there's no
fraud.
Yeah, exactly, no fraud. Sorry, you were going to say.
No, well, you're right, Marianne. And the thing is with it, sometimes those people that are from those particular countries, and they change all the time, so I don't really want to say any. I always like to check the list, but I mean, you can have a gift come in from your parents from wherever in another part of the world. And as long as it's in your bank 90 days, it now becomes your money and you don't need a gift letter.
Okay.
So a lot of times I'll say to people, they'll panic. They're like, oh my gosh, that was my whole down payment. And I'm like, well, all we have to do is, we'll check with the seller is if we can move the closing date ahead to make it all work. I mean, it's not ideal, but people just don't always realize these timeful dating. Everything's so specific.
Okay. So if I came to you and said I want to buy a house and I need a down payment and I have 20,000 down. Do I? So I want to buy a house and I have 20,000. Do I have to show where that came from? Is that an important piece of the puzzle? Because at this point, you don't know if it's my money or my sister's or my, parents or.
Yeah. Any kind of money like that, we need a 90-day history. And sometimes if you're very new to Canada, they'll want like a 1 or 2 year history of your banking. So it really just depends on that. But you always have a 90-day bank statements for sure. And also 90 days of your stocks and bonds, anything like that. RSPs, you can get 35. I should have mentioned that you can get up to 35,000 each person buying the house out of your RSPs without any tax consequences. So that's another one, 90 days you need of that.
Okay.
So,
So I'm just writing that down, 35 days RSP. So it sounds to me like that's very much a, cover our butts kind of clause, just to make sure that there's no issues with that down payment. Because I always wondered why you needed a letter saying this was, and also that was the other piece of it, because I remember that you need a letter saying it was a gift. And I think that was so that you could show that you didn't have to pay it back. Because if you have to pay it back, it's now credit and is part of your debt ratio. Is that right?
yep, if that's what was happening, yes.
Yes. Okay.
Yeah.
All right. So, which is the other one, the other idea that came up when we were talking was, lines of credit, credit cards. Again, if you have credit, you can potentially take it from that, but then you have to be careful of that playing into your debt ratio and owing too much money, because that's going to impact what you qualify for. Correct?
Exactly, Marianne. You're right on there.
Yeah. So, again, I hope that this is, is painting the picture for viewers that there's so many pieces to the puzzle, which is why it's so important to talk to someone beforehand. Look at what you think your plan or strategy is going to be if you have one. If not, develop one. Time frames are going to come into play. You might have to clean up your credit report or score. Like, there's just so many factors that don't just go kind of running forward doing stuff because it may not be the right stuff, right?
Absolutely. That's really what the key is. A good plan and execute as soon as the right time happens, you can execute.
Yes. Okay. So we talked about creative financing ideas. And this is where I feel like you very much shine in terms of, really pulling together creative ideas for people if they don't quite fit into the mold. And certainly, when we're working together, because I work in the bankruptcy industry, let's face it, my clients often don't fit in the mold because they're having financial difficulties. They have low credit scores. They probably don't have down payments, and there's been some debt issues. So one of them was pulling packages together before it's presented. So just tell us why that's so important.
So getting all the information like to submit, is that what you're kind of?
Yeah, and I
Yeah,
think I think it's one of your superpowers is that,
yeah,
and I'm sure there's lots of mortgage brokers out there that do this as well, and probably most of them to some degree. But yeah, that you basically gather all the information well in advance and make sure you dot your I's and cross your T's and have everything you need before you ever present it, right?
yeah, and that is true. And I'm probably, because of my accounting background, I'm super paranoid of not missing something, some minor thing that will blow the deal up. So I like to get everything sorted. I go through it myself. I have a great conditions team that does this for me, but I'm that particular about some of my trickier deals to go through it, because I don't want one thing going to the lender unless I know I can have a reason for it. And then if I know it's going to not make it, of course I wouldn't send it. But most people, if the journey is clear, and the lenders are wanting to lend money, so if they can see a reason, and we've had some doozies, Marianne, and once the people understand it's a great client that just had a rough time or what have you. Yeah, being prepared and having everything done so the lender just can see the picture, it helps. I would say I fund so many deals just from that. I've had lenders say, you know what, this has been on my desk 3 times and been sent, go away, not funding, and you've actually got it to the funding stage. Congratulations. I'm like, whoa, really? They're like, we don't know how you did it. And I'm like, well, me neither then. But but I think you're
Awesome.
right. It's like you give me so much info, I collect everything I can, and then we do a good package for sure.
Awesome. Just before we continue, I want to say hi to Hashem. I see he's on watching us, so I have a comment here from him. And he's asking, if we get a 5-year term on a mortgage, do we have to keep getting approved for a loan every 5 years? Can you answer that question for him?
That's a great one. Basically, you will get renewal paperwork in the mail that you can just sign, and it'll usually just keep rolling from most lenders. But I would say this: the smart people, long, maybe 6, 7 months before that happens, get in touch with myself or your mortgage broker and take a look at where rates are and what products are out there, because typically you can save money and you can actually be prepared and do quite well by maybe having a little bit of time to get a better plan, because the rolling one is just, you're going to get whatever the standard rate is. So I would say, yes, you could just ignore and let it roll, but smart of you to pop in and see someone. And you may want to do a refinance. So take a little equity out and pay some bills or do a reno. So I'd say you can let it just roll, but I think there's better options, and you should chat with a broker before that happens.
Yeah, and what I've seen happen, and again, let me know if this is still true today. But I always told everyone, because they would be on that renewal, and so I would say pretty much what you said. You're going to get a piece of paper. It's going to auto renew, or you have to sign. If you don't do anything, it may auto renew. I can't remember what the stipulations were. Or you can look at, changing the term, or qualifying for a better rate. Like, have some discussions with them. So just coming back to Sham's question for a second, when someone does that, so if I'm in a 5-year and I come back and say, I want to put this in a 1 year, or I want to put this in a variable and not be locked into a term, is there a new application at that point, or what is the process that happens on the back end?
Well, depending on what lender, if you take a little look around, you can stay with that lender and just let it go into whatever they've got as a product. But the beauty of mortgage brokers are, we have 40, 50 options every time you're renewing, and we don't have to stay anywhere just because that's where you are now. So, I mean, the only thing of switching, which is, if it's a straight switch, there's no legal cost. A refinance and go in through another lender, there's a legal fee. So, I mean, it's really to their advantage to get the best deal every time, and then just switch, and there's no legal fee. It's so easy.
Okay. So again, I'm just going to follow that through one more little thread just to make sure it's clear. So let's say I have you got me a mortgage, and it's a 5-year term mortgage, and I'm coming up. So it's 4.5 years in. Don't wait until 4 years and 11.5 months, everyone. So let's say it's, 4.5 years in. And I'm like, I don't know that I want to do a 5-year term. So I would come to you and say, Jeannie, this is coming up for renewal in 6 months. Can you let me know what my options are, right? And then you would look at it, and then you would say, well, you can, renew at 5, and you can stay where you are because that's the best rate, or you can go over here because it's a better rate, right? You're going to go through all of that and advise what makes the most sense, correct?
Absolutely. Whatever is the best for the client.
Yeah. And it might mean a new approval, but if I'm in a situation where that's likely not going to happen, you're going to take that into account in your recommendations.
Yeah. And most of the time, if you're already in a mortgage, it's not as tricky, unless, of course, you're now unemployed. And a lot of times people let those just roll over because they don't have to say anything. Yes. I don't know how much the lenders or anybody likes that, but it does happen. So
yeah.
I don't know how that works.
Great question, Hasham. I thought that was a great question, and really kind of branched off into some really important tidbits for people. So the bottom line is, no, you don't have to be approved, but if you do want to make any changes, you might have to go through an approval, and that's why you want someone in your corner to help navigate through that, right?
It's perfect.
Awesome. Let us know if that answered your question. And if anyone else has a question, please feel free to post it. As you can see, I'm keeping an eye on the comments, so we'll bring that in. So going back to creative financing ideas. So you mentioned private lenders. This is always an area where I know I say the word sometimes and people cringe. And because they equate private lending with astronomical interest rates, which is not always the case. Tell us a bit about private lending, where that comes in and when that's useful.
Well, they can come in so many different places. For instance, you might have a mortgage, but you need to do like a major renovation. Say, I don't know, say your roof, something big has happened, it's not covered by insurance, or you have a reno, you just want to get it done, and your mortgage isn't up for another year. So sometimes it's too expensive to get it. So you can get a second mortgage. Typically, that would be through private lenders. Some alt lenders also do it. All of the alt lenders and private lenders charge usually a fee. It can be from like 1% to 3%, sometimes higher in the private lender world, up to 6%, maybe more. And then people go, oh my gosh, the rates are ridiculous. Pure private lender, the rates can be anywhere from 8.99 to 15 and even higher. But just think about this, Marianne. If you go to a bank and say, I want to have an open mortgage, the beauty of private lenders, they're like open mortgages. So you say, I'm going to keep it for 6 months or a year, usually never longer than a year. The bank is going to charge you a premium because they don't know, is this guy going to make us do all this paperwork, or lady or whatever, going to do all this paperwork and then basically pull everything out in 12 weeks or 1 month. So this way they make it 8 or 9%, typically even bridge financing at some of the lenders, banks. Privates might be 9, 10, 11, 12, 13%. But when you're doing short term that way, you got to expect they can't do it for free. So, that's kind of where the rates are. Bridge financing is big. A lot of private lenders will do that quickly, and not always as cumbersome as some of the financial institutions. Just depends. But yeah, I'd say I actually love the private lenders, people that are in the middle of a foreclosure and they've got, 1 week to pay up the bank or lose their house. Usually a financial private finance will come to the table in some of those situations and actually be the savior of the day. So they do have high rates, but look, they'll jump for the right situation. They'll jump and help people like nobody's business. So I do get the rate thing, but I'm actually more happy that they've helped me so many times now that all the bad things I used to say, I take them back.
Perfect. Well, if there's any private lenders listening to the replay, jump in and say hi. But I like the way that you, I like the way that you frame that, and that's what I found as well in helping people to do types of refinances, is that oftentimes the private lenders do fill that gap, right? So I mean, you're not going to go to a private lender and get a mortgage if you can get a mortgage at a traditional place. But yeah, in the case of foreclosures, I mean, I've had so many people that contact me. It's like, oh my gosh, I got a notice and they're taking foreclosure action. And don't sit on that stuff and ignore it, because if you sit on it and ignore it and it gets too far, it can be really challenging to bring you back from that. But if you reach out, I mean, I've worked with mortgage brokers in the past to stop foreclosures and get people back in their homes, and so it definitely has come into play there. And also, I think what I'm hearing you say is that private lenders are really good for, short-term solutions and, sometimes Band-Aid solutions and, bridging the gap and using it in a very strategic way that somebody may need at that time, which again is why it makes sense to talk to someone, to know what you're getting into, and to have a plan B, which is to get you away from the private lending in a reasonable time frame. And private lenders don't want you hanging around for a long time. Like, these are short-term financing. That's why they have fees, I suspect, because they don't want you hanging out with them for 5 or 10 years.
Yeah,
right?
I mean, it's so true. And sometimes if someone calls and says, Jeannie, I need a mortgage in 3 days, I know there's not a financial institution or normal regular lender that can make that happen. So right away, my brain will jump to private lenders and I'll send out a few emails. And sure enough, they'll come back and say, well, if you can get me this, and this today, then we could probably pull it together end of tomorrow. I'm like, whoa, this is incredible.
Yeah. Awesome.
So,
Love that.
yeah.
Okay. And then I don't know. Oh, I just want to mention, so Jeannie says alt lenders, just in case anyone doesn't know what that is. It's alternative lenders, meaning not your main 5 banks. That's the way I always describe it. So you have your main banks, and then alternative lenders would be other lenders.
And actually, Marianne, they're the ones that are 680 and under lenders.
Okay, 680 and under. So basically, if your score is below 680, then you're going to be dealing with an alternative lender.
Yeah.
Yeah, perfect. I wrote down creative financing ideas, gift from grandparents, etc. But does that already fall into what we talked about with the ideas for down payment?
Yeah, and they typically like parents and siblings, but they will take, you have to get an exception from many of the lenders for grandparents. They don't like, say, common law. They don't want one giving to the other, that they won't take it as a gift. There's some funny stuff you have to be careful on. So, first thing on your list for your mortgage broker plan and chat is, my gift is this, it's coming from there. How do we...
Why do they care where it comes from? I've always wondered that.
I don't know. I think it's because maybe the, mothy or something.
This is the conspiracy theory part of the show.
That's what Marianne and I get all of our grocery money.
So if anyone knows the answer to that question, post it in the comments.
Yeah.
But I always wondered that, like why they needed to know, came from your, mother or your sister or your brother or whoever it was, other than kind of that money trail. But to me, grandparents, like family, parents, grandparents, I would think would be on an equal footing.
Yeah,
So.
and they typically will approve grandparents and uncles and aunts, but it's just not always on their list. You have to get an exception, which isn't a big deal, but you still have to ask for permission. It's just another checking
It's just
of the box.
it's another stepping stone that you have to go over,
I mean,
right?
they're so worried, and rightly so. I mean, there's so much fraud and so much stuff going on that I think they're just they really want to make sure if it's your money and your family's money, they really want to make sure that is where it came from because there's just so much happening.
Yeah, well, that makes sense.
Especially with identity theft and stuff, right? So
yes, yeah. Okay, that answers that question. So we're going to move into what you need to know before house hunting. Now, this is obviously going to go a little bit into real estate stuff, maybe more than mortgage brokers. So we're just going to keep this confined to your knowledge because obviously real estate agents will come in and deal with this on a different level. But one of the things that came up when we talked about that, speaking of real estate agents, they really like for you to be pre-approved before you reach out to them, right?
Absolutely.
Yeah. So are you finding that a lot? Do you find, I guess, how often do you find it's happening that someone contacts a real estate agent, first starts looking for a home, even puts an offer in the home and then has to go get approved for mortgage? Does that even happen anymore these days?
Typically, it really isn't happening that way. And if by chance you just go out on your first day of looking at houses and something like transpires, I'll get calls from agents that I deal with a lot, and they'll say, Jeannie, look, they want to put an offer in, but there's other offers pending. So unless you can tell me they're going to be able to make a proper offer, we can't accept an offer from them, which is kind of I'm like, I understand why the people are frustrated, but there's just so much going on with these offers being above asking and stuff like that. So if you know your maximum, and then typically agents that now, a lot of the real estate agents I've had call me, they want me to give a letter saying, here's the range. Because I'll tell you what, I can't give you that, but your client has it. If they want to share, they will. But yeah, people, they just want to keep them in the right ranges because there's just so many heartaches and headaches with all these offers these days.
Yeah, because then they're conditional upon, like I remember when I bought my house, I didn't get pre-approved. I probably didn't even know at that time it was a thing. So, I saw a house and then I wanted it. And then I went I think we put an offer in and then we had to go get financing. So it was conditional on financing. And I can see how in today's market, real estate agents are going, no, that's not happening. Like there's way too many offers. So, I think that's a piece that a lot of people miss is they just start looking for a home and instead of, okay, I'm going to add an element to this. So what can I afford from the lender's perspective? Because that's when they would go to you and say, what am I pre-approved for? The little piece I wanted to add to that is, and I always tell this to individuals, look at that, but then look at also what can you afford from your perspective. Just because you're pre-approved and the bank says you can afford it doesn't mean you can afford it. So, incredibly important to bring that back to your own budget or spending plan and make sure it's affordable. So I think what I'm hearing you saying is real estate agents are really kind of stepping in here and going, okay, if someone contacts them, are you pre-approved? What do you qualify for? And if they're not, they're going to bounce them back to someone to find out what they can get approved for, right?
Yeah. And the thing is too, there's different, like I do a pre-approval. When I do mine, I'm looking at simply fill out my application, send me 2 pay stubs and, your 2 T4s. And I can tell from that pretty much that it's a pre-approval, but I can tell from that you will get qualified. A lot of people rely on different people who just say, okay, how much do you make? They write it on thing. How much is this? They write it on thing. I mean, to me, that's great, except when the person goes to finally get that financing approval and they go, oh, you know what? We didn't know you had a car loan too. Oh, we didn't see. Now you can't approve. And I get people coming and going, our financial institution or whoever, another lender, whatever's happened, we were pre-approved and they can't do the loan because those pre-approvals sometimes don't have enough info. They look good until they do the actual paperwork. So if you really want to feel confident shopping, you want to get a mortgage broker. There's myself, there's some others out there too. But I mean, we like to make sure our pre-approvals are actually good at Ideal Mortgage. The guys that own our place, they're like, don't tell them they're pre-approved if it's going to blow up. So we try to do a mini review just to keep people feeling safe and confident when they shop. And it really makes a difference.
Yeah, so that kind of goes back to you pulling the package together before it's presented and really make sure the I's are dotted and the T's are crossed.
Yeah, for sure.
How long is it taking to get approvals for people right now? Are we talking weeks, months?
I can send in within a day or two. Just an easy, straightforward, everything's there, like income and such, and a decent credit score. You could get that same day information. Okay. Wow. If you got a little more stuff to be creative on, we could work on a file and have it sent in and maybe back within a day or a day and a half. The problem is getting them all closed because you have to wait for appraisals and different things that are taking time.
Right. So the pre-approval's pretty quick. So if someone wants to buy a home, they can get a hold of you. They can do a pre-approval. They can get that pretty much right away. Yeah. It's that the financing. So then when they find the house, the financing, finalizing that is taking time.
Yeah.
Yeah. All right. So we were talking about selling and buying and some challenges. Down payments was a big one. We already talked about that. We also talked about short-term private lending and where that comes in and why that's important. I don't know if we talked about this one, property value versus credit score. I hope you remember why I wrote that down because I don't.
Property value.
Is it maybe
probably because of the interest rates, right? Because your property value, you're going to have a higher interest rate if your credit score is poor. They want you to have a house that's actually going to be usable if you default. Now, the other part of that too is the bidding up of the pricing. So if you go to buy a house and say you put an offer in, the asking's $350, you put in an offer of $450 and you win. So now an appraisal has to happen. And if the appraisal comes in at $450, you're fine because the lender's going to fund. If the appraisal comes in at $400 and you're paying $450, you've got to come up with that difference in cash. So it's not just the down payment. Now you need to have the cash.
Right. Oh, I bet that's been an issue in today's market with the overbidding. I never even thought about that. So
yeah, it's been crazy, really crazy. And that's where you can get into private lenders, second mortgages. You can get into gifts from everybody you know. Like there's a lot. Sometimes
that's where creativity really does have to come in.
Yeah, your lines, like we'll say, if your lines are clean, we can get an exception to maybe use that for the overage. But like you said earlier, Marianne, it's got to get added to the ratios. So, I mean, we always seem to find a workaround, but that's the creative. You got to really.
I feel like you've been extra creative this past year or two.
That's the Mortgage Jeannie magic.
That is the Mortgage Jeannie magic. There's
creative solutions.
There's two phrases that I know what they are and I kind of understand them. And I mean, I have a fairly good knowledge of the industry. So I figure if I kind of understand them, there's probably lots of people that don't know what they mean. Bridge financing. Explain bridge financing.
That is a really great one. And it's big in this market as well. So if you are selling your home, and say you have a solid purchase and sale agreement and the clients that are buying your home have met the financing conditions, and you say that home is closing on, I don't know, June 28th. So say you go out now and find the house of your dreams and you have to close that house and you get a purchase and sale agreement and now you need to meet your financing terms, but you won't have any cash, right? You don't have the
And I'm waiting
cash.
for the money to come from the
Right.
sale of my house.
Right. So there's that part. Or the people will say, no, we don't want to wait till the same closing date, which is tricky. So that's when we go into, there's a couple of great private lenders for that. And there is a couple of, I'm trying to think, I think there's one major bank that does it as well, fast, but the fast ones are the privates, but they'll come in and look at it and they will actually do, it's kind of like an open mortgage where they will pay that first mortgage out, all of it. And, you don't have to pay them back till your house closes.
Okay.
But you
Bridging the
have to
gap between selling your house and
right.
buying the new house and selling your house, because buying the new
Yeah,
house is going to happen first. And then you bridge that gap. And then when you get the money from selling your house, you pay the private lender.
right. So they want a firm purchase of sale from your client because, of course, you don't want to have two houses.
So
Right.
again, really important where someone like you comes in to make sure the I's are dotted, the T's are crossed, the proper documentation's there.
Yeah.
They're going to want that kind of third party validation before they
Yeah.
take that risk.
No surprises.
Yeah. Perfect explanation. Let's see how well you do in the next one. Port your mortgage. So I've heard this term many, many, many times. And again, I kind of get it, but I would like to hear your explanation of it. What does porting your mortgage mean?
That's another great one. So basically, if you use a mono lender, which is a lot what I use, or a bank or whomever, they have the portable mortgage product, meaning if you go buy a house today and your mortgage is portable, you can call up the customer service. They don't really want to deal with a mortgage broker. They want you to go to their customer service people. I always get involved just for support, but I don't do much other than give them, go back and say this, go back and say that,
I
go
do
do
that a
this.
lot.
So, but yeah, basically you call up and then they will say, yes, you can port it. First of all, what I always do is tell them, make sure you know the areas you can have a mortgage in. Some are restrictive, some are not. Make sure how much you've actually got, any fees, which there's typically not too many, but always something. And then basically you can port it. The problem that happens is if you port a $300,000 mortgage and the house you're buying is $600,000, now who's going to give you a second mortgage? Because no one likes to be second.
Right. So it has to
So
almost be an equal footing, because you're basically, by porting, you're taking your mortgage with you. So if I'm selling my 300,000 home and I'm buying a 300,000 home, I'm going to my mortgage person
yeah,
place. Can I just take this mortgage to the new home and they do all the paperwork on the back end and say, now we're going to secure it against this new home? If
yeah,
I'm buying a $600,000 home, they're happy to do that, but now I have to find somebody else who will finance the rest.
right. And so there is good news is there is good second lenders, but they're the evil people lenders that everyone's like, oh my gosh, the prices are so high because once again they've got second place,
Oh,
the
they're
risk
second.
is higher, and
Yeah.
they want to be compensated for taking on higher risks. So sometimes what I do is I'll sit and do an analysis and say, look, you know what? Your rate, if you cash in and don't port, your penalties are so low, you really don't have any. But your interest rate for a second is going to be 13. So here's how it would look. And they're like, oh man, maybe porting's not my best
Maybe it's not
option.
your thing. Is
And I
this a
go,
common oh, sorry, go ahead.
yeah, no, no, no. So that's kind of what I do is kind of size that up for them.
I was just gonna say, is this a common thing? Like, I've had mortgages throughout my lifetime. Have some of them been portable and I just didn't know? Is that something you have to ask for? Like, I don't even think I've ever remember hearing the term portable in any of my mortgage business I've done.
I think it just depends if you've dealt with mortgage brokers or not, because I always try to find products that have low penalties, porting, different things. And I always explain that to the clients. I
Mm.
personally started off in not with a mortgage broker, like back when I was, a baby. And I didn't even know what my mortgage said. Like, I'm surprised I got this far because until I actually was brave enough to say, "What can I see my mortgage? What does
Yeah.
this stuff mean?" But yeah, but I think it's good to know. But most people, like a lot of people, do have portables. I think they're just figure like I don't want to get in to try to figure that out. And it's really not hard. You call customer service, they tell you the rules. You
Mm.
have to give them so much time, and then work out kind of what your second mortgage rate will be because that's kind of where I find my deals start off, oh, it's so easy, do this. And I'm like, oh, yeah, but the second mortgage is bad.
Right.
You may not want that.
So, a little piece of homework for those of you out there, get out your mortgage document and read it. Yes, I know that incites terror in us, but scan it and see if you can find anything in it that says portable so you can
Yeah.
see if that's part of your mortgage or not.
Yeah.
I may have to do that. I have a line of credit mortgage, so I don't think they're portable. Well, I guess they kind of are. Well, I don't know. Are they? I'm going to ask you that.
Yeah, you'd
I
have to check the rating because HELOCs, like the
I have a
lines are
Manu one mortgage that,
oh,
dangerous mortgage that, yeah, can be really,
it's
really good or really, really bad. I have
yeah,
that
and
one.
that's linked right to your house. So you can't without you if you sold that house, you would have to pay out all that Manulife,
Yeah.
the busy account. So, but
Yeah.
yeah,
I don't
it
think
should
that one's portable.
it should say there what your options are for sure.
So there you go, a little piece of homework. So we are coming up to, we're at the top of the hour. So I have one more item I'm going to bring up. If anyone does have a question, just post it and we'll get that answered before we finish up. But the last question that I had for you was home equity, leave it or use it? And I always talk about there's a thin line between financial strategy and financial disaster. And I have seen people on both sides of this line in various places in the business that I do. I've seen people who don't do anything with their home equity and then have high interest debt that they're paying, which makes no sense to me. And then I've seen others who continue to take the equity out of their home to get themselves out of debt. And of course, that's more on the disaster side. So, where do you fall in that? If you have equity in your home, does it make sense to use it? Does it make sense to hang on to it?
Well, I mean, everybody always has had the focus to pay off their house. My parents were that way. My grandparents got to pay off the house, got to pay off the house. But I find now the higher prices, people's new philosophy is, I'm never going to pay off this house. So, which could be true when you owe millions of dollars. I mean, it is kind of tricky. But I guess for me is I say, like, you don't want to pay a big penalty to refinance. But sometimes when Marianne or myself, we can work out how much interest debt you're going to have from waiting 3 more years and not pay off those credit cards and stuff. And when you start seeing 30, 40,000, and really all you're doing is servicing the debt because you're not making any dent in it or dent in it. I mean, sometimes it's just time to accept that you got a problem and let's refinance. But then you also need a good budget. Like
You need
Marianne
a
takes the
plan.
people and make a plan and a budget and really size up like what got you here. Because the worst thing like you can do is have to keep doing this every 3 or 4 years because you're always going to feel stressed and worried about, oh my gosh, how did this happen? So I mean, I'm not sure lots of people are in this boat right now from COVID. They were on serve, their jobs, so we're refining a lot of people, and they're really just cleaning up that 2 year mess. But I guess the trick right now is how do you stay stable from going backwards, with work and stuff. So it's never easy. It's a real effort. You almost have to sit down once a week and look at your mess and say, oops, I goofed again. But
Yeah.
the refinances they save so much money and they really do. I mean, they can change your life. You could have $500 a month in interest payments no longer going out that you could put away to save. So why not take advantage of that? And even if your credit score is bruised and you pay a little more interest, 6% interest versus 29 or 19,
Hmm.
you're still winning. So
Yeah.
I'm all
I think you hit the nail on the head when you said there has to be a plan, right? And I'll steal our good friend Maureen's statement. If you fail to plan, you plan to fail. And and that's where I sit on this decision. So if you have equity in your home and you're not doing anything with it, um, great, build up equity. That's wonderful. But it's there to be used strategically, in my opinion. And so if you're carrying debt at a higher interest rate and you can refinance it at a lower, it makes sense, but only if you have a good plan to pay it off, or if you're going to buy a car, why wouldn't you put it under, a mortgage at 3% versus a loan at 5 or 6, if you can, right?
yeah.
So I think strategically done, it can work in your benefit. It can save you money, but there's that fine line where you can step over into disaster and you can just keep pulling your equity out to bail yourself out or to live above your means. There's where it really gets risky, pulling it out to live, above the means that you have. And then you're just basically using your house equity to do that, which again, if that's your intention, by all means do it. I had a guy once, I was in a workshop and I said, and I was talking about that, and I said, it's your equity. Like, I always call it your back pocket resource. And this was a retirement planning workshop, which is the other piece of this. When you and I were talking, you were saying, age consideration. So how long you're going to have. And I said, consider it your back pocket resource. So you're going to retire. You've got a house, there's equity in it. You might need that money for something important down the road. And now you have it. So I said, what would be important? Now, most people say, I got to renovate the house, or there's some medical needs, or the sewer backs up, right? Like these really big things that you potentially need it for. One guy said, buy a Harley. And I'm like, hey, each their own. Whatever's important to you. If you want to pull the equity out and buy a Harley before you die, absolutely. As long as it's a good, conscious decision and you have a plan in place and you can afford it and you've decided that's what you want to do.
Yeah, that's funny. Some of the things are
yeah.
And fun.
or travel around the world or anything. So, all right, that takes us a little bit over the top of the hour. Hisham did come back and say thank you for the answer. It was truly informative. So, really glad that answered your question. And I think we are going to end things off there. But anyone listening to the replay, if you do have a question, please post it. Jeannie and I will be happy to jump in and answer it for you. Jeannie, thank you so much for hanging out with me. I knew I was going to have fun with this. I also knew I would go over time because I feel like I could just sit and talk to you all afternoon. And, I think the way I'm going to end this, actually, before I do that, I'm going to ask you if you could give one piece of advice to those buying homes today. Let's say new home buyers. So one piece of advice to new home buyers in today's market. What would that be?
I think the most important thing is to really talk to a mortgage broker, because we're specialized, we're licensed, we're specialized in the full plan, and it's free. So you don't have to, you don't have to pay anything, but we have lots of resources, connections like Marianne. I mean, it's worth, you can have such a great plan and be successful and shop with confidence if you just take 20 minutes and, call a mortgage broker. I know myself, now we're all licensed in the province. It really is great. We're highly trained. We're focused on mortgages. There's no competing things that we sell. So we are probably one of your best resources. So by all means, give us a shout.
Yeah, absolutely. I'm going to second that and just say yes. If you are considering buying a home, whether it's your first or second or 10th, if you are considering refinancing, because let's face it, in today's market, that's a very viable option, then be informed. And so reach out to Jeannie. All her contact details are at the bottom of this broadcast, so you can grab them there. You can just post in comments if you have any questions. And I think that's one of the things that Jeannie and I both share, is we do have a deep desire to help others have happier, healthier finances. Although we do that in different ways, we also do that collaboratively together. So thank you so much, Jeannie. And I am going to end the broadcast, but please stay on. We'll have a little chat at the end. And everyone else who viewed and posted questions, it was lovely to see you. And those watching the replay, please do a hashtag replay. And if you have a question, post it and we will answer it there.
Thanks so much, Marianne. It's been an awesome hour.
Awesome. All right. So let me end this.